Yes, good afternoon, ladies and gentlemen, and our guest today at our special webinar, Key Trends for Offshore Investing in 2021. My name is Magnus Heystek, and I'd like to say hello to our fellow presenters. We have Mike Schüssler, the consulting economist to the Brenthurst Wealth Group. Mike is going to be talking about the events in the local economy, pre and post the unrest. Then we have Magda Wierzycka from Signia, who's joining us from London and talking about the global mega trends that she's very involved in and investing clients' money. And we have participated in some of her very exciting and innovative schemes. And then finally, we'll be joined by Glyn Owen, who's been running the Brenthurst Global Balance Fund for 10 years, the Brenthurst Global Equity Fund for 4 years. He's with Momentum Investments in London and has been a very good friend to the Brenthurst Group over many years. When we started planning this webinar, that was pre-KZN and the unrest that has exploded. And it makes it very timeless that we discuss these events, especially in light of what could happen over time, what impact it will have on investment confidence, and so forth. So just as an introduction, I would just like to go through a couple of slides to set the tone for why South Africans more and more should be investing their assets offshore. But I'd like to start with the second. Why is my slides? Okay. So sorry about that technicalities. We're still new with this, but let's go for the headline that appeared in the Business Day in April, which I think I'm going to publish more and more as time goes by. And the author, is a London-based columnist of Business Day, had this ridiculous headlines: rocketing JSE Aussie leaves offshore investors, advisors with egg on their face. And he carried on about the sudden rise in the JSE from October onwards. And for a very brief period of time, the JSE was one of the top performing funds in the world, mainly on the back of the commodity boom and the very, very rapidly rising prices of platinum and commodity shares. But he ends off this talk by saying, so the next time the Anywhere but SA bandwagon comes charging past, see it for what it is, a creaking wreck filled work for those who make a living selling the negative story. Now, I don't fully understand why this journalist feels so strongly about it, because if you look at the facts and what we are trying to show investors is that these are the facts, these are the 10-year returns of the JSE versus the major indices of the world, the NASDAQ, S&P 500, the MSCI World Index, S&P Europe, emerging markets. And according to this, and this is priced in dollars, the JSE has been the last or the worst performing sector in the world in dollar terms. And despite the 80% rise in the market from October onwards to the end of April. We can do the same in rands, and you'll see the same pattern. South African investors who are bound by the JSE have shown very little growth after inflation. And if you compare it to the bigger markets of the world, the S&P 500, the NASDAQ 100, etc., you will see that it's been a fantastic call to have had some of your money invested in offshore markets away from South Africa. Now, the article kind of alluded to the fact that when the Rand was at 1935 on the 22nd of March last year, we went out and urged all investors to take their money offshore and put it into a dollar account, which is simply not true. We have been advising responsible offshore diversification for a very long time. We started 10 years ago when we launched our own fund in London, and Glyn will talk about that. Pardon me. And you'll see that by and large, it's been a very, very good strategy for many reasons. One was diversification, and later on we had the political issues in South Africa. Here is an interesting table that I discovered a couple of days ago. It shows the market capitalization of the top 20 listed entities or stock exchanges in the world, with the New York Stock Exchange with 26 trillion market cap, followed by Nasdaq with 19, Shanghai, Japan, Hong Kong, Euronext, etc. And coming in at number 20 was the Johannesburg Stock Exchange, which is still very good to know that the JSE is one of the top 20 markets in the world. But if you go back a 10 or a 20 years, you will find that the JSE was around the year 2000, about number 13 and later number 17, and we are now number 20 in terms of the big players in the world markets. And the Tehran Stock Exchange in Iran, for instance, is now a bigger stock market than the JSE, and also the Taiwan Stock Exchange in Korea. They've overtaken South Africa, and as you can see, we are becoming a smaller and smaller player in terms of world markets. Partly, and this is a very worrying chart, and I don't create the facts speak for themselves, but since 2016, South Africa has suffered a tremendous outflow of foreign capital from the JSE, and I feel very strongly, having studied economic history for many, many decades, centuries almost, we are dependent on foreign capital for most of our investments in South Africa. The gold mines, the diamond mines, the platinum mines were, when they started, mostly financed by foreigners. The last 5 years, we've seen a substantial outflow of money from both the equity and the bond market. And if you look at those lines, the bonds are the orangey type of tables, and the equity is the blue. You'll see mostly outflows around about October 2017 to April 2018. There was a bit of an inflow to our markets, and that coincided with much stronger JSE and also a stronger rand. But since then, if you look at the table, onwards from April, March onwards, it's been a horrendous picture of outflows month after month after month. And if you add it all up, the net outflow from our stock market, 539 billion rand as of yesterday, and also an outflow of more than 100 billion from our bond market, despite the very attractive yields on offer. So this tells me that the investors, the foreign investors, have been taking the money and investing it somewhere else. And our stock market, ladies and gentlemen, will not increase or start showing real growth if we don't make it attractive for the foreigners to come back. So that's as far as the outflows are concerned. The same has happened with the number of listed entities on the JSE. We are now at about the same number of listed companies as before 1994. We had a very, very nice rally from 94 up to 2000. And that is when we about peaked in terms of new listings. We had more than 600 companies. In fact, we had 602 listed companies. My apologies. And since then, there's been an outflow of companies, mergers, buyouts, and so from 600, we're down to about 320 companies. And I understand there's a lot of potential delistings in the pipeline. So that again tells you something, that the JSE is not functioning as it used to in the old days in raising new capital by means of IPOs and listings that can be used and deployed in the economy, which is again a very bad sign. And as independent analysts, we have to talk about these things because it does have an impact on the investment returns of our clients. And there seems to be many people in media who don't like it that we talk about this. It's considered disloyal, unpatriotic, negative, etc., etc. But these are the facts. We don't make the facts. We can only respond to these facts for our clients. Now, here's a very, very busy chart or table, again, on a 20 to 15-year period. And it shows you that right at the top, the fastest growing asset class was, of course, interesting, the United States Federal Reserve's balance sheet. that has been growing quite worryingly, but NASDAQ was on 15%, and this is dollar terms, and you can have large caps, 500 index growing at 9% per annum in dollar terms. And right at the bottom, you will find in dollar terms, if you price the JSE in dollar terms, we've been growing at compound of less than 2%. And in fact, if you strip out what we call friction costs, you've actually made 1% in dollar terms by investing your money in the JSE. And that perhaps explains why the foreigners are investing in other parts of the world, because they get better returns. Japan, 10%, and we can carry on. I mean, it's not been a good period for the JSE and a lot of investors on the JSE. There's another chart from Dwayne Fearon, who draws up these charts. He's from the Recession Alert, who gives us very good information. And there again, you have the same. That is over a 15-year period of time. A dollar return of the JSE is around about 1% per annum. And if you were a foreign investor, you were not happy with this. You simply took your money and you invested it in the rapidly growing NASDAQ, S&P 500, the Russell 2000, and the other markets that have been performing much, much better. Now, let's look at the rand and cents consequences of investing locally and investing offshore. And one has to reread this to actually understand the full implication. Let's assume 10,000 Rand investment over a 10-year period. These are the Rand returns. And I took the four largest of our equity funds. And the results are as follows. Allan Gray with 24,000, Coronation Top 20, 26, Prudential 29, Old Mutual Investors Fund 21. So you effectively got back your money plus 2 or 3% growth in real terms. In fact, the Old Mutual Investors Fund, you actually got less money back after inflation. They made more money out of their management fees than you did. Had you put that money into just a fairly well-managed global equity fund, the Orbis, which is part of Allan Gray, and it didn't perform very well over that period of time, you had 50,000 Rand in the bank. And one of the funds that we've been using for 10 years, the Franklin US Opportunities Fund, your 10,000 Rand has turned into 82,000 Rand. Now, just think of the financial consequence depending on your investment choice. Had you put your money offshore, you've more than doubled the amount of money in the local market, and the American market has given you 8 times the amount of money that you put in. Now, you can work out what the results are. And for this reason, we are considered to be negative and unpatriotic. But I can tell you, our clients who took our advice in the early days and consequently throughout the last 10 years have shown extremely good returns. They've built their global wealth, and their position is substantially better than people who have not taken the advice. And you can do it in the same, comparing our global balance fund with local balance funds, whether it's 8 years or 5 years, and you don't have to take this down, but these results will be published on our website. Again, the picture, if you don't want to go for the higher risk funds, go for a balanced fund. And again, the returns are much better offshore, or have been much better offshore, whether it's 8 years, 5 years, 3 years, it does not matter, ladies and gentlemen. And there again, this table, and even over a 1-year period, despite the strengthening of the Rand from 19 down to 13.20, had you invested offshore, you effectively still outperformed the local funds. Our local funds have not been doing very well, and there's a combination of the asset managers in conjunction with the media. They tend to hide these numbers extremely well. And there again, last point about the charts, people say to me, yes, but it's the exchange rate that makes the difference. Let's take the last 5 years, where the exchange rate, in fact, has been quite flat, and you've made no money as a result of the exchange rate. You're only dependent on the growth in the underlying markets. And there again, our market has given us very poor growth compared to the world index, the S&P 500, and the NASDAQ, which has been superlative. It's trebled your money So in this chart, the exchange rate plays no factor, all to do with local growth, local profitability. Just to put it into context from a macro perspective, South Africans, the South African economy, and Mike will talk about this, South Africans are becoming poorer over time as a result of exchange rate, low growth. And our objective at Brenthurst is to protect the purchasing power of our clients in dollar terms. And maybe Mike will say something about that a little bit later. Now, everybody talks about this massive discount and the JSE is so cheap. One has to ask why. Why is there such a big discount? And we can talk about it all day long. Is it politics? Is it the ANC's policies? Is it corruption? Is it the unrest? It's a melting pot of a lot of things. But when people say to me, you should be buying the JSE at this point in time, they might be right, but I still don't see the signs that I can recommend offshore investing, as opposed to certain financial advisors or fund managers who yesterday made this ridiculous statement that if he was an international investor, he would have 30% of his money in South Africa. Now, that to me is just ridiculous. We're less than 1% of the world markets, and this is just plain marketing and hoping to draw some money in. One point I must stress about the difference between fund managers and wealth advisors: we are concerned about the outcome. By law, by moral standards, we are very concerned about the outcome to our clients. If a fund manager is wrong in his prediction, nothing you can do about it. That was their view. And it's quite a bad scene that people can get away with making these kind of statements. I'd rather put faith in someone like Rob Rose, who's the editor of the Financial Mail, one of our more critical journalists, who basically says, who dares invest in South Africa right now? And I think just before the unrest in KwaZulu-Natal, Gauteng, there was an IMF study done to what happens to countries and their economies and markets after a state of unrest like we've experienced. And it's been downplayed by the press, but Rob Rose and some of his fellow journalists have analyzed it elsewhere in the Financial Mail. And it basically says those effects are long-lasting, they cause structural damage, growth is lower, confidence is dented, and foreign investors will sit on the sidelines. When a company like Toyota, ladies and gentlemen, warns the Durban municipality that it might pull out of South Africa, you mistake it as a severe sign that the foreign investors and someone like Toyota says we might pull out is a very, very serious sign. I'm going to leave it at that. That is the introduction. We are talking now to Mike Schüssler, our consulting economist, and we hand over straight into Magda Wierzycka, who'll talk about global themes, global trends for some of our clients and investors who invested in the Oxford Sciences Innovation Fund, doing very, very well. That's a type of theme that she's been cultivating and investigating. The Signia Fourth Industrial Revolution Fund, where lots of my money is involved, and some of the other ideas that she has and what she's looking for our clients. And we will end up with Glyn Owen all the way from London. So from me, until later, it is goodbye and welcome, Mike.
Okay, I hope I've unmuted myself and you guys can hear me. We're going to go straight into the presentation. The first thing I did, this was built on a presentation I did for Magnus and his team. And the first little presentation thing is just an interesting graph of how the world can change. It's not to do with investing. I don't sell motor cars, and I don't even know who the electric vehicle companies are in China. They're much bigger than Tesla, by the way, or sell more. But here's an interesting thing that my data provider did as an example, and I'm just using it. And just to clear our cobwebs from all the very near-term stuff I will talk about, and then longer-term stuff a bit later. And, you know, economists also have to be not just economists, I guess. Otherwise, we get so boring, it's unbelievable. But here you have a 12-month moving average of new energy car sales, in other words, electric cars. And in China, they're now selling over 2 million of these cars a month over the last year. That is amazing. That is 4 times the size of the South African car market, which is small in world terms, I know that. And then alongside that, you can see the public devices, the charging devices that are on its way to 1 million of them in China. I was just out of interest, just to clear our heads for what's coming. I think I'm going to not say too much about the vaccine rollouts, but around the world, the vaccine rollout is incredible. At one stage, it was 0.5% of the world's population receiving a dose a day. We're now down to 0.4% because there is a bit of vaccine hesitancy, and the emerging markets or the poorer countries, the low-income countries, are not very geared to this at all. But nonetheless, by the weekend, we should reach 53 out of 100 people, or doses per 100 people type of thing. That's quite a significant amount. You can see our third wave peak is over, and finally we're starting to heat up on the vaccination charts. We should be about by 12% by tonight of our population, which is at least a start, and we do know more vaccines are rolling in. So I think from the point I want to make is, from the sort of lockdown levels that we got before, I don't expect much more lockdowns, not back to a level 3, 4, 5 if we get the vaccine rollout before the next wave. Here you can just see the time spent at work. And what's very interesting is that since about May, South Africans have not spent much time at work compared to other territories. North America is just Mexico, Canada, US. South Latin America is the 6 countries, the biggest economies there, Chile, Brazil, Argentina, Uruguay, and Peru. But you can see they also now are more positive than we are at work. And that just tells me that South Africa is maybe not going to do quite as well as we think. We will do a positive growth this year because of the base impact. Not going to say anything on this because for some, but I want to stand a little bit by the riots. My one other client is called BankServe Africa, and they do the transactions between banks, not within a bank, but between. They're the middle of the banking system. And here you can see the credit and debit card and ATM transactions and how that was impacted by the riots. Now I'm going to go through the yellow here is level 2. You can see a slight leveling off of economic activity. This is on the 30-day or 1-month moving average. Level 3, slightly more down. And then level 4, you can see a significant downward trend. And then that purple line, the dark purple line, is when President Zuma over here was arrested. And after that, you can see how the impact was on the spending in South Africa and the millions of transactions we lost. Now, we had come back up to about 4.8 million. These are also just days here when SASSA grants are paid or not paid. But you can see basically here for a long time, we're at about 4.8 million on average. Then we drop right back to 4.2 million transactions. And that tells you that a lot of people just didn't want to go out. There was fear for consumers. And that 9% drop in transactions is for 15 days is huge after the riots started in the economic thing. We know it will come back for the month end again, but we want to see what's going to happen after that. But it tells you that South Africa is in serious trouble on the consumer side. You can just see the workplaces, and I'm just using the total country here to KwaZulu-Natal. KwaZulu-Natal dropped back to where they were literally when level 5 lockdowns happened. The rest of the country dropped down to about a level that we saw in December when there's anyway a lot of holidays, and early January. So we know that that's going to have an impact as well. And you can see the retail length of stay. Limpopo and Northern Cape are very small. There's obviously some grant payments going there as well, and that makes a large part of their economy. But you can see Western Cape, KwaZulu-Natal, and Gauteng, the 3 biggest provinces, are all over 16% down in the length of stay at retail for a 1 month period. That's a huge impact. People were not shopping as much. And that tells you that the economy is going to get some sort of a knock from that. Then the direct impact, which me and Elise Kruger worked on, we know that there's about 200 shopping centers. 200 shopping centers. That's not in towns, plaza shops and so on, were damaged or looted. That's between 8 to 9% of the total shopping centers. To rebuild those buildings, not the ground, just the buildings, will be in the order of about 14 billion rand. We think that the if also 8 to 9% of your final goods were taken, we know at the end of March, we had 634 billion rand in inventories in South Africa. If you say that between 8 and 9% of those inventories were also then damaged, and it's not just at the retail level, it's at the distribution, factory level, so on, but most inventories in South Africa are stocked at the retail level, then that damage will be about 56 billion rand. We also know about 40 trucks were damaged. It's a smaller amount. We also know exports stopped even through Richards Bay Harbour. That will have an impact. So we think, conservatively speaking, 60 to 80 billion rand impact. And I know the others are smaller, but this is really, we worked hard on it to get there. But the problem isn't the direct impact, because some of that you'll fix and some of that you'll catch up. Some insurance will pay out. But here's the thing. Government is going to get a lost revenue. They're now spending more on social grants as well, on SASRIA, on everything else. And that will impact on the amount of money that they're going to need. Now, they have some revenue will be lost, but luckily we're in a commodity boom, which I'll talk about at the end. But they're going to have some money come in. So the whole impact is not going to be, taking us from a 7% deficit, which would have been closer to 6 or 5 as a percentage of GDP for government deficit. It's going to be back to 7.5%. But it's still, relative to other countries, we are going to look silly. And that's part of the problem. The employment impact, we all know, and we know we need jobs. It's our biggest problem. The confidence. I've spoken to so many people, just normal small business people who are very, very close to closing or giving up or just not interested anymore. And it's not something you can measure, but we will get business confidence from the BER and consumer confidence. And I think both of those will have a big impact on fixed investments, so that'll be lower. The foreign perception, FDI, but tourism as well, growth, obviously this will impact growth. And I think this political crisis management that we've got is very short term. So we're going to spend 36 billion extra on the riots and the looting. We're going to spend extra 18 billion on salaries. That takes us over 50 billion or 1% of GDP. So any tax, extra tax revenue we were going to have is going to go away on this. And that will impact on the credit ratings and the cost of borrowing, which already takes 1 out of every 5 rand. 1 out of every 5 rand goes towards borrowing or paying off our debt. I just have one big, massive question, just in the interests of time. But where are the arrests? 3 weeks ago, you told us on the 9th of July, the minister stated very clearly that there was an insurrection. They have 12 suspects. There's going to be arrests soon. We've arrested a minor player in the Western area, and we've arrested a DJ who was granted bail today. I'm quite sure they were not the insurrection that was told or sold to us. Now, the other thing is, just on a different note, but now we reward people with giving them a grant. So people get this lesson and say, right, we had fees must fall. If we burn a bit and we intimidate people, we will get a university. Now, the same is happening with the basic income grant that people want. It's starting to happen that way as well. It seems if business wants anything, we'll have to hunt down SARS officers. I'm not saying you should do that, but it's the strangest reward. And then on top of all this, in the last week, I've been really busy with this, but South Africa processes about 13,500 20-foot containers, but it works out to about 40, on a 40-foot container, which is most of them, 95% of them, it's 6,500 containers a day. You can't do that manually. I don't care who you are. We're still struggling. It's now day 8. The containers are not moving as quickly. And you can imagine, in Durban alone, it's 4,100 containers a day. That means 3 containers have to move a minute on 2 piers. With a walkie-talkie and a laptop and phoning the trucks and telling them when to come, and then they have to present papers which have to get stamped, and it's a whole process. It's not going to be quick. You can do it, like, for example, with a vaccine drive, there is obviously a manual process involved, and you can do quite a lot, but you can't do thousands. And that's the point I would want to make here. So there's still damage being done here. The world economy very quickly recovering far better than we thought. South Africa was going to do much better. I think it's not going to do quite as well, but this is just the IMF data, and it is, in the sense, still quite negative. But nonetheless, we look at the 10-year average of South Africa's 1.3, the emerging markets is 4.6. So 3 times the growth that we have. Here's 2 slides that just show you that the world container throughput is doing, but the one slide, I'm just showing you what our container throughput has done before the Transnet problems, and you can see that we have not kept up with the rest of the world in the growth of containers. And that's telling you right now that things aren't moving as quickly in South Africa as they are in the rest of the world. You can see that from the economists' forecasting poll of forecasters. I think the 3% is probably a bit low here, but I think we'll get in at let's make it 3.9, 4.1, somewhere there, because we had a very good first quarter. But here's the thing about the world, and I'm going to just change into the world mode now. The world money supply is growing quite rapidly. It has slowed in the recent past, and you can see how that correlates to world equity. So world equity prices are still positive, nearly 39% on a year ago, and they will remain, but I think it's not going to be the same sort of hectic growth. I think we can probably more likely to have single digits than double-digit growth in the world equity markets in the next year. But you can see the money supply here and the return on the Morgan Stanley Total World Index. World debt has gone up from about, before the pandemic, from about 220 trillion percent of GDP, sorry, to 262% of GDP. We haven't yet got the second quarter data in here, but I suspect we'll go over 270% there. World inflation is starting to pick up. We see it in world export prices. The average world inflation has stayed above 5% for about 3 months in a row now. So that will have an impact. And I think we are heading to a world of higher inflation, or at least higher inflation than we had in the last while, where very often inflation was actually quite negative and it was deflation rather than inflation. The US put equity ratios were very much close to all-time highs. They've come down a bit, but so has the US equity index changes also come off from its very heady growth. And that was what I would like to point out. The other thing that I think is a danger sign, I'd just like to stay at this graph a little, that the amount of households in the US that have exposure to equities in their financial assets, according to the Federal Reserve Bank, has reached 40% for the first time. It's no fluke, in a sense. I think 2 things happened. Equity prices went up because there was a lot of money chasing equities. Why was there a lot of money chasing equities? There is no alternative. You cannot put your money into bonds or cash at these sort of interest rates. And so of the big three asset groups in the financial markets, not talking houses, hedge funds are too small, commodities are too small, Bitcoin is too small, all those sort of things. If you do believe in alternative currencies, I don't so much. It tells you that the move to equities had to happen. And depending on how long this lasts, that could also be a good sign. But so far, we know that once this comes down, equities could come down a little as well. On the emerging market side, I'm not so positive about South Africa. We're not bad in everything, but here you can see the gray one right at the bottom. We are in the one in the third from the end. Our biggest problem is our budget balance at 7%. Compare that to all the others. We could have come better with a higher than expected take from our mining sector, and we would have been closer to a Brazil or Argentina, which are also in problematic territory there. So our debt to GDP ratio is very likely to go up. And on last year's, when we still have everybody here in the same period of last year, end of last year, we're about 80% and one of the highest ones, I think the third highest one after Argentina and Brazil. Where we've done well in the last year is our currency has done very well. That's mainly due to commodity prices. You can also see that other currencies have done quite well. Mexico also due to commodity prices. The Brazilian real was virtually zero. But obviously there's others like the Argentinian that have their own crisis. The other thing on the good side, where we were on the good side, I think this will change, but the geopolitical risk, we were seen as having a low risk geopolitically. And once you go over 100 here, it's not a good thing. South Korea I find surprisingly high, but that's because they got North Korea on their doorstep. And internal politics as well. But nonetheless, I think our 47 points here is likely to rise. And I think we are going to see that after the looting. Obviously, this comes out only periodically. The economic freedom is unlikely to change much, but maybe go down a bit. But so two of our good points are under pressure here. If we look at 10-year bond data, well, South Africa is quite high, not quite as high as some, but we are quite high for an emerging market. And I think, you know, the failure rate of a Brazil or a South Africa is probably for the immediate future small. We know that we can pay from our taxes currently for the next 2, 3, 4 years. So that's not too bad, but you can see we are being priced as a risk premium. Now, there's a good thing to this. If you're in the South African bond market and you are going to stay in South Africa, it might be okay to have a bit of in bonds, not just equities, because you have a bit of an alternative in that. But I'm not suggesting you should only put it in there. But certainly at the moment, that is for an investor, you can look at it from the other side. It is obviously an inverse correlation, but nonetheless, the point is that the world sees South Africa as higher risk. And 500 basis points above the average emerging market out there is not a good signal which we want to give. And during President Ramaphosa's time, not all his fault, but to be 400 basis points above, that's higher than Mr. Zuma was, and definitely higher than Mr. Mbeki was. Just a thing, you know, if we again look over periods, 1 year period, 5 year periods, 20-year periods, 30-year periods, all that. The one interesting thing, the further you go back, the fewer emerging market currencies there are still in operation today. Now, some currencies joined us later for, you know, they were part of Eastern Europe. So you didn't have the Polish and the Romanian currencies. That's true. Or you had the communist version of their currencies and it wasn't really traded. And now we're in a new era, though, but you can see that a lot of the currencies have been replaced. We have one next door to us, the Zimbabwean currency. So emerging market currencies, just generally speaking, seem to be diving or seem to be weaker against the developed markets, with probably the exception of China and the Eastern European countries. I have a sneaky suspicion that China will be viewed more as an advanced economy in the next decade than they are now. So you want to maybe look at that as well. As you can see, China, most of this time period, did quite well, although on 40 years ago, obviously quite badly. You can see here some currencies have virtually lost 100%, such as the Brazilian real, over that time period, so 30 years. So that in itself says something where you want to be. The other thing is the emerging market exchange rates. You can see here, South Africa has picked up in the last year, but I think, we decoupled. Our risk factor decoupled. We were always a proxy for other emerging markets, so that did give us a bit of an up and down movements. But I think right now, with the commodity boom, it's helping us, and I think it could help for a little while longer. But the point that I want to make is, on a long-term basis, we have decoupled from the emerging markets. And these numbers are from JP Morgan. So it's not like we're trying to make this up. This is a pretty steep discount. Can get a bit smaller maybe in the short term, but I think longer term, I expect it to be doing more of the same and decoupling further. You can see also over a decade view, there's only been one decade where the Rand held out a bit, and that was during a high commodity decade. And I don't think this boom is going to last quite that long. So that's the one thing. Here's the Rand purchase power parity and how it plays against the purchase power parity. So on a 8-9 year purchase power parity basis, we've now overtaken that's that brown line. The red line tells me that we're stronger than we normally would be in 50% of the cases. So I think right now the Rand looks strong to me. I'm not doing the Rand on a daily basis. I didn't watch the Rand this morning. I'm looking at when you've got a Rand at 14.50 or 14.80, it's still strong compared to what its median has been for the last 8-9 years. And as Magnus was saying, you can see in the last 5 years, the Rand didn't move too much on a purchase power parity basis. Yes, we had a big decline in the beginning of the pandemic, but we've come back because of the commodity boom, and we will be probably a bit stronger. But one thing on a fundamental basis, we all know the Big Mac, and we're very cheap on Big Macs. But Big Macs work with labor prices, they work with rents more so. But if you look at tradable, and it's not tradable, so it's okay to tell me that the Swiss pay 5 times more than my Big Mac. I could fly it there, but they're not going to take it from me because it's going to be old and they want it immediately. And an aeroplane isn't a drive-through. So, you look at this and you say to yourself, some goods here, you can see in the yellow already at these sort of levels of May. You can see chicken was more expensive in South Africa. Gasoline was more expensive, or petrol. Milk was more expensive. And then you go to the other side where you get to, say, 10 Rand, and you see how many more goods get expensive. Sugar gets more expensive. Beef mince gets more expensive. And that says to you, when you're at about 13.60, you're already getting to territory where a lot of goods could be imported a lot cheaper. And give or take transport costs, obviously, as well. But the point of the matter is, when you get to 9 Rand, virtually, more than 3/4 of the goods here would be cheaper in America. So it's unrealistic to get back to a 6 Rand thing, as the Big Mac index points out. Our equity markets have also decoupled. Magnus was pointing that out. And it's quite strange. We seem to follow the same pattern, but we move a little bit slower upwards and more sharply downwards than the most of the emerging markets. The big break was end of 2015 with the firing of Minister Nene, but since then we haven't recovered. I think there is a chance that we can get the gap down a little bit, but I don't think by much. I really think this is not some, because even before Nene, you could see there was a start of the decoupling and it just carried on. And I would hope we get back a little, but I don't think so. Forecasts are out of the window on South Africa. This is still the Reserve Bank. This is the May forecast from economists all around South Africa. But what I've read from most of my colleagues, everybody's going to drop their forecast with a 0.5 to 1%. Because of the rioting and the looting, the lockdown. I don't know what impact the Transnet thing is going to have, but probably another couple of comma points there. We will have positive growth this year, but I think we've seen most of the positive growth for now, because it's going to be quite a dip. And then in the end of the year, we might see some construction picking up and obviously refilling of inventories, which will be interesting. Just last point, commodity prices. You can see that the Fed funds, it's inverse here. If the Fed fund rate is low, commodity prices do very well. And this is just the Economist magazine's metal index. It's the one I prefer using of the world indexes. And you can see how that fares every time the Fed keeps rates low. When the Fed increases rates, typically commodity prices don't fare as well, and they go well. But here you take the same metals price index from the Economist magazine that you just saw, and you trace it to the Rand. And yes, the Rand did fall a bit more than would be expected, but it does sort of follow the trend. So I think while commodity prices are relatively high, you will have a reasonable Rand, and that's a good time maybe to view the future 5 or 10 years from now, because you might not get this chance much again. And yes, the Rand can still strengthen back to, I think, 13 Rand maybe at one stage, or 13.50, but those chances are small. They're less than 25%. That's my long and short of it. I think, you know, if you take out some, that's a good thing. Also, the interest rates in South Africa are still high, so that you keep here. So Rand stronger in the short term, longer term is weaker. The other thing is all equity prices, all equities are far slower growth at the moment, I foresee. There could be a possible correction at 10% or 12% decline. But outside of emerging markets, because there are many emerging markets that have higher rates, I don't know where else you can put your money. Maybe the two investment guys following me have better ideas. I'm not the investment son. But the other thing, in this world where your debt levels are so high, the central banks are motivated to keep rates lower for longer. So I've also made that mistake and kept a lot of things in income funds and everything like that. That's horrendous. They don't do well in this environment. So you actually have no alternative but to look for things in equities. You have no alternative but to look for maybe some emerging market bond funds. But ultimately, low interest rates also help commodities, so that's one thing. But we also even don't have that many commodity options on the JSE. As Magnus pointed out, there's not many funds available here. But ultimately, I think they will have to let go, because you can't keep interest rates at zero forever. So I think we'll see that for the next 2, 3, 4 years. And in that time period, cash ain't an answer. I'll leave it there and I'll hand back to the rest of the crew.
Well, thank you very much. That's a good summary of the economy and where it's likely to go. We now go to the question, where can we invest in the world, the global mega trends? And we have Magda Wierzycka from Signia, the founder of Signia, one of our medium-sized asset managers in South Africa, and also a big player in the ETF, the low-cost ETF sector. And we partnered with Magda on many very exciting investment products. So over to you, Magda. You're in London and you're going to be telling us about the next phase of your career now that you're the executive chairman rather than the executive director of Signia. Over to thank you very much for your time, Magda.
Absolute pleasure, Magnus, and thank you to everyone for listening. You know, I have now spent more time overseas than I have ever done in my life. You know, my career has really been South African centric. And it is interesting that, you know, spending time outside of South Africa, you see things very, very differently. So, you know, I always have been a South African optimist. And I guess, you know, living in South Africa, you have to be. But, you know, the other day I read a quote by Harry Fourie, who is the CEO of Capitec. And basically what he said is the following. You can go to Switzerland where everything works, but there are no opportunity, or to South Africa where nothing works, but there is plenty of opportunity. Take me back 5 years ago, and I would have completely agreed with you. I look at South Africa now, and I look at South Africa from the outside, so no longer, you know, from the inside. And I do not believe this quote. You know, everything that I'm seeing around me in the developed markets in particular is thriving. There is plenty of money around. There's, you know, the quantitative easing obviously and the money printing has helped. There are plenty of investment opportunities. There is no shortage of, you know, interesting investments. And hence, you know, I no longer believe that South Africa is a land of opportunity, which I think is very sad. And, you know, re-emphasizing some of Magnus's comments on the JSE shrinking. I cannot tell you how disappointed I have been with the listing of Signia. It really has been a pointless exercise for us. NASPA's domination of the JSE. I mean, effectively, we serve as a money-raising channel for Tencent. We've seen the outflows by foreigners. And again, you know, sitting in London, I was absolutely horrified by the coverage of the violence in South Africa. And some of the South African commentators who, you know, had the opportunity to promote South Africa on international news, and instead, you know, the only words out of their mouth were negative words. So watching the images and, you know, rather than commenting on the fact that the violence that one is seeing was localized as it was, the commentary went very much along the type of commentary that, you know, we can share among ourselves as South Africans, but we certainly don't want to project forward to international investors. So we can't even do our own PR particularly well. And hence, you know, when one looks at the rand, as much as, you know, there are strengthenings and some of it, yes, commodity boom, a big part of the strengthening of the rand actually has to do with the weakness of the US dollar. You know, I do believe that the long-term effects on the rand will be negative. You will see long-term weakness of the rand, and one cannot underestimate the effects of the recent violence on the fiscus. Because, you know, all this excess money that we had that could have been spent on, you know, anything from police force to infrastructure spend to job creation has suddenly been and has to be deployed to fix this 50 billion rand loss associated with the violence. So what are we seeing internationally? I mean, I think that, you know, the biggest factor that everyone is watching in terms of where investment markets are going is the inflation in the US, because the inflation in the US will guide the Fed in terms of increasing interest rates. And, you know, as much as they are at pains to say that they're not worried about the fact that inflation in the US has stayed at higher levels for longer than they expected, the moment they, you know, slow down on the money printing and the stimulus in the economy, the interest rates are going to shoot up. And the moment that that happens, the rand weakens, the dollar strengthens. So inflation really is the major factor. The other one that, you know, I've been observing from the sidelines is the ever-growing China versus US trade war. So, you know, we had the beginnings of the trade war under Trump, and, you know, the intensity of that trade war has not decreased under Biden. And some of it obviously has to do with the optics and the politics of the pandemic and the causes of the pandemic. But, you know, we just had Biden announce that, you know, he expects government departments in the US to channel 60% of their procurement into US produced goods and services. So, you know, not dissimilar to South Africa, you suddenly have trade protectionism from the US. That obviously will have huge impact on inflation in the US because, you know, just at the very basic level, you know, the price of steel goes up, the price of anything that you import will go up, and the price of domestic production goes up. And obviously China is not going to respond well. And what we have seen from China just in the last few days and possibly last month has been these random crackdowns on technology, self-driving cars, education. And, you know, it all smacks of a couple of things. One is, you know, punishment of companies that have grown too big for China. And it smacks at trying to, by force, lure those companies back to a listing in Hong Kong rather than listing on the US stock market. So all of a sudden, you know, you have China engaging in, you know, I don't want to call it market manipulation because, you know, absolutely everybody is entitled to, and every country is entitled to do whatever is in their best interests. But you are certainly seeing China moving their investment opportunities to their exchanges. So, you know, in terms of thinking about investments, we just had an investment committee meeting at Signia this morning. We discussed the fact that you actually have to start looking at opportunities in the technology space and start segregating opportunities that are available in the US and opportunities that are available in China and trade those two markets separately. So you no longer group tech as, you know, one thematic. You actually have to look at it separately and invest in it through separate stock exchanges. Now, you know, the other thing that I'm observing is and being in the UK and obviously on the fortunate side of the vaccines, is that the vaccines are certainly driving the opening of the economies, and significantly so. And unfortunately, that means that emerging markets are being left behind, and significantly so. So if you look at, you know, US, you know, part of some Trump red states, the economy has largely opened. In the UK, everything has opened. So, you know, the only restriction is some very minor restriction on, you know, wearing face masks in shops and some gathering restrictions, but very minor. So what you're seeing, and you know, I was in Spain, completely open economy. I was in Greece, coming from South Africa, because you have to transition through a country that isn't South Africa before you enter the UK, completely open economy. So countries where, you know, they have had access to vaccines and they've made, you know, very significant effort at marketing themselves again as tourist destinations to Europeans and to the, you know, British, are opening up. Now, you know, if you look at emerging markets, nothing is opening up. So yes, you know, one can, you know, I think South Africa has pulled a rabbit out of a hat in terms of, you know, its access to vaccines all of a sudden, but it's still only 12% of the population. There is a long way to go. And unless the population is fully vaccinated, you know, the travel corridors are not going to open to South Africa. So, you know, no one has South Africa on their wish list or priority list in terms of opening their borders. So we are right up there with, you know, Brazil, India, South Africa. And unfortunately for us, and for any emerging market where the services sector is a big part of the economy, such as, you know, tourism sector, that is a death knell. Because we are so dependent, and the job creation in the country is so dependent on the services sector. So, you know, I don't expect the tourism sector to, again, recover anytime soon, and that has all the secondary effects on, you know, lack of growth, lack of investment opportunities. So you know, unfortunately, you know, it's not a very pretty picture. And also, you know, in this world of post-pandemic, what one is seeing is increasing level of nationalism. So I spoke about Biden and US and manufacturing and purchasing domestically. You're seeing exactly the same thing in European Union and in their fight with the UK. In terms of Brexit, you're seeing the same thing happening in the UK. So there isn't a whole lot of charitable view of other markets. It's almost every man for himself, and it manifested itself in the procurement of vaccines. It's going to manifest itself, and this is the important point, in terms of job creation and investment. So governments will direct investment towards domestic opportunities rather than offshore opportunities. So really the only thing that South Africa has going for it, the one and only, well, two things. One is a little bit of a commodities boom, but I suspect that that is coming to a very rapid end. And the only other thing that we have got going for us is the high interest rates that you can still earn in the South African markets. Take that away, and I think most of the foreign investments would dry up. Now, that brings me to where, Signia is investing and, where I have been focusing on. I launched the venture capital fund in the UK, which focuses on the IP or commercialization of IP emerging out of the Oxford University. Most of that IP has to do with healthcare and life sciences. And that's our Signia OSI fund. And we also have investors who have come directly into our offshore funds, the Bravos funds. And, we have a lot of questions about the price of OSI shares. So OSI, Oxford Sciences Innovation, is a company with, roughly at the moment, I think 500 million pounds on its balance sheet, and it has exclusive rights to commercialize all IP emerging out of Oxford University. And it has already spun out 99 companies. One company has listed on NASDAQ, Vaccitech. That's the company that has developed the Astrazeneca vaccine, the IP behind the Astrazeneca vaccine. And on a positive note, AstraZeneca has just announced that in real life, so this is real life data, not laboratory, the AstraZeneca vaccine shows 82% and 87% effectiveness after one dose against hospitalization and death. And that is against both beta and delta variants. So maybe we shouldn't have been so quick to dispose of our 1.5 million doses of AstraZeneca. Now, in terms of OSI, the question that gets asked is, that the share price of OSI is not moving up fast enough. The truth of OSI is there are no sellers. So this whole pandemic has brought to the fore the value of the OSI shares to investors, and the fact that it represents not only what OSI has created to date, 99 companies, but also all future IP originating from Oxford. And with the pandemic, with AstraZeneca vaccine, that has become apparently clear to every shareholder in OSI. So guess what? No one is selling. I asked my investment team this morning, because everyone has some OSI shares in their portfolio or in their own personal portfolio. And I've asked my investment team, what is the price at which they would sell their OSI shares? And the other answer from our top investment professionals was, there is no price. We would not sell the OSI shares because the value of OSI shares will continue to increase, which at a point will translate into a very significant value appreciation, and already is underneath the umbrella of OSI. But given that there are no sellers, there are plenty of buyers, people who want to buy at whatever levels. But because there are no sellers, you're not seeing the movement in the share price. So, what I would expect from OSI, and I'm one of the very significant holders of OSI shares, and my answer is the same. I'm holding these shares for life, and I am passing them on to my children because the value creation will be significant. And it's a long term. So expect the value to come in a staircase mode. But it will only obviously happen if someone sells their shares. And for the last 6 months, we have seen no trades in OSI shares. Now, the other fund that we have launched recently has been one driven by healthcare innovation, focusing specifically on healthcare, and that fund has done amazingly well. Obviously, it invests in all the companies like Pfizer's and Moderna's that are involved in the vaccine. But this pandemic has brought to the fore a couple of things. It has brought to the fore mostly the complete inadequacy of the healthcare provision worldwide, developed markets and developing markets. Why have people died? Well, a couple of reasons. Obviously, healthcare related comorbidities, obesity, age. I am not underestimating age, but a big factor also has been inability to access healthcare in time. So, going forward, governments are going to spend a lot more money on healthcare provision. And if you just look at companies like Pfizer's, Johnson & Johnson's, AstraZeneca's, the COVID-19 vaccine is an annual shot that you will be getting. It's like a fluke shot. So the prices will come down in time, but effectively you will have a continuous demand for the vaccine. So, we do believe healthcare sector is a very exciting one. And then now that I have been kind of immersed in this area of, alternative investing, venture capital investing, and I have seen some amazing things, there are two things I'm launching, apart from writing a book, by the way. One is for South Africa, and that's probably a little bit altruistic rather than, a money generating. So I'll talk about it last. But I'm also going to the US in the next few weeks, and I'm going to spend some considerable time there. And the idea is to look at an opportunity, given that OSI is very much life sciences, healthcare oriented. There is a lot that is happening in the technology space. And a lot of incredibly exciting companies that are mostly based in the US, coming to the market in the US from the private space. So, one of the things that I want to look at is the opportunity for setting up a venture capital fund, which is purely focused on technology. And we will bring it to the market in South Africa. The other one, the more philanthropic fund that I'm setting up, and it's not a retail investor fund. So I'm only mentioning it from an interest perspective. And that is, I've learned a lot through my journey with OSI, setting up venture capital funds, running venture capital funds. And I would like to do a similar thing in South Africa. So set up a venture capital fund, which is in progress, and look at commercializing the IP coming out of our leading universities. So amazingly, through this journey of looking at South Africa, I've already discovered the gem that is University of Stellenbosch, where they have a similar structure to OSI, obviously on a tiny scale, but where they have spun out some incredible companies which now need capital. So I am setting up a venture capital fund in South Africa focused on the IP originating from South African universities, supporting South African entrepreneurs. Not a money-making venture. It's more about job creation in South Africa, because if we don't start creating jobs in that economy using small and medium-sized enterprises, if we don't give them capital, access to capital, then frankly, you're looking at a massive spiral downwards. And that's really me. I've been quite busy after becoming the executive chair of Signia. So instead of my work reducing, my workload has increased, but it is an exciting, time. And, hopefully I can still bring all these themes to you through these kind of webinars. And thank you to Magnus for inviting me.
Magda, thank you very much. You answered some of the questions we had about the OSI. I can also say, and I agree with you, I bought for all my grandkids, I put some money away for them in the OSI and for my daughters. And I've said, you're not going to touch that for the next 10 years because I believe in the theme, I believe in the story. So thank you for that, Magda. And thank you very much for your time. We know that you're extremely busy, and we're very honored that you came and spoke to our audience today. Thank you very much, and enjoy London. We now say hi to Glyn Owen. Glyn, are you online? Nice to see you.
I am, and I'm just getting some slides up, Magnus, so just bear with me a seckie.
But let me tell our audience that you've been running, and we've been doing business for more than 10 years. You've been running our very successful Brenthurst Global Balanced Fund. It's now 10 years old.
Yep.
It's almost R1 billion fund, outperforming the bigger brand names. It's beating the Orbis managed fund. It's beating the Sanlam managed funds. And in fact, over the last year, Glyn, you've actually beaten your index, which is very rare for a balanced fund.
Absolutely.
And you're also running a very low-cost global ETF fund for us, the Brenthurst Global Equity Fund. And it's a very good time to be talking to you and asking your view of South Africa from the City of London following the tremendous unrest that we've seen in our country. So, Glyn, thank you very much for your time. You've got about 15 to 20 minutes. We look forward to hearing you.
Excellent. Thanks, Magnus, and thanks for inviting me. I'm sure you'll recall, Magnus, it's about 2 years ago, June 2019 was the last time you invited me to one of these seminars, which was a physical one. And I referred to the cycle that was then moving along, that this time it's going to be very different. Well, little did you or I, or frankly anybody else, know just how different it was going to be, because within 6 months or so, we were subsumed by this pandemic, which resulted in the most extraordinary crack in economic activity that any of us have ever seen. The big economies around the world shrunk within a matter of days by 25–35% as you had these lockdowns. And of course, as this slide shows, stock markets responded to that in exactly the same way. It was the most brutal and fastest bear market we had ever seen. In a month or so, markets fell by 35%. And this slide shows all the major markets. The US is the purple line there. Then you've got the world ex the US, emerging markets. They all fell pretty much in a straight line. But you can see what has happened because of the huge level of support that was provided by governments and central banks almost immediately that the pandemic struck. There was a very, very rapid recovery, and that was reflected in the movement of stock markets. And indeed, many stock markets have now moved to all-time highs, as you alluded to earlier. The US has led the way, I think, largely because it's come out of this COVID crisis pretty well, but more importantly, it's dominated by the big tech companies, the pandemic winners. They represent a big proportion of the US stock market, and they've really been huge beneficiaries and done extremely well. I mean, arguably, they've sort of brought forward revenues from the next couple of years. The Amazons, the Netflixes, the Googles, and so on, the Microsofts, you know all the names. I just wanted to point out too on this slide, incidentally, those lines that sailed through the crisis were really US government bonds, US treasuries, that brown line, and US TIPS, which are Treasury inflation protected securities. These form part of the Brenthurst Global Balance Fund that you mentioned earlier. They're in there for defensive reasons. The TIPS, which are bonds issued by the US government, but their coupon, their interest, and their principal payment is linked to the level of inflation. They've been a really very good investment indeed over this period, and have indeed performed as well as some equity markets, as you can see, and much less volatile. The other investment there that's part of the global balance portfolio is gold. It did very well through the worst of the crisis and continued to do well through last year. It's come off a bit recently, but we still feel it plays an important part in these multi-asset global portfolios at a time when there's just so much liquidity around. And inflation has picked up a little bit. It's something that to us is a good preserver of capital in difficult times. But it's really equities that have led the way. Emerging markets, that blue line recently has actually come off quite a bit. And a decent part of that is China. What is going on in China, as Magda and Mike alluded to, is actually quite worrying. And I'll come back and chat about that when we talk about some of the risks. But let me just talk about where things are going to go from here, because that's really what this is all about. There's absolutely no doubt that economic recovery in the developed world has exceeded all expectations. It's come sooner and more rapidly than any of the forecasters predicted, in large part because of that support from governments and central banks. And corporate profits are responding in a way that, again, nobody forecast. In the US this year, corporate earnings are going to be up by between 40 and 50%, extraordinary numbers. Now, at the moment, in the short term, there's no doubt that the Delta variant and the potential risk of other mutations cast something of a cloud. It's causing some weakness, particularly in the emerging world, some parts of the US that Magda alluded to, and it's delayed reopening in some countries. But we do think that's very short term, and I'll explain why in a second. Inflation has picked up as this release of pent-up demand that we've seen as economies reopen has restricted supply. Then it has pushed up inflation pretty sharply, and Mike talked about some numbers. But importantly, inflation expectations remain pretty restrained, and I'll talk about that. Now, the other key thing that's happened in recent weeks is that the monetary tightening cycle has started. And here I refer to the US Federal Reserve. The US is by far and away the most important country in the world in terms of its impact on the world economy. It's the biggest. The central bank is the most important. The dollar is the international reserve currency. So a lot of my comments will be based on the US. But the monetary tightening cycle has started. The Fed indicated that a month or so ago. It's going to start to rein in these huge asset purchases that you referred to. It's indicated that it will begin to increase interest rates, but my word, it's going to be extremely cautious. It's going to be a very, very long, slow process. It's going to be a long time even before the first interest rate rise comes along. They really want to make sure that the economy is through the worst of this crisis. They don't want to tighten policy too early. Other central banks are in exactly the same position. So we're going to have loose monetary policy for a long time to come. The other big thing is that fiscal spending is going to remain high. Unlike after the financial crisis a decade or so ago, when there was a period of austerity to rein in government debts, it's quite clear that's not going to happen this time around. So you're going to get continuing support from fiscal spending. Yes, the huge pandemic-induced high levels of spending that we've seen, they will fade away as the pandemic fades from our sort of concerns. But there's absolutely no return to austerity. Now, I think at the moment what we're seeing is the rate of growth peaking out, this great surge we've seen in the developed world of activity levels as lockdowns have been eased and restrictions have been eased. We're allowed to carry on getting on with our lives pretty much in a number of countries. So we've seen the rate of growth peak out, but my word, I don't think we're going to see any great slowdown. This cycle has got a long way to run. Economies are operating well below capacity. So as both Mike and Magda mentioned, we still think that the risk assets are going to move higher through this cycle. It's a long cycle, and equities are going to drive returns. So I'm just going to expand on some of those issues now. The COVID one is pretty straightforward. The UK is the biggest economy and the furthest that's gone furthest through its population with the vaccination program. So it's an extremely good example of how successful vaccines are being and how they will get us out of this pandemic disaster that we've had. So what we're showing here is the 3 waves of the virus in the UK. In terms of numbers of cases, there's a 7-day moving average. That's the light blue line. Numbers of cases are the reported cases. In practice, there have been many more people with the virus than that, but nevertheless, they'll have followed the same sort of spike. In the first 2 waves, hospitalizations absolutely soared. That's the brown line there, followed the direct path of the number of cases. And of course, the big concern, the reason why so many countries, ourselves included, had a lockdown was to ensure that the health service didn't just completely collapse. So I can see it now, those pictures of the Italian health service collapsing back in whenever it was, February, March last year. Nobody wanted to go through that. And here we've managed to get through it without that happening. This time around, you can see what's happened. There's been a great surge in cases, that's shown on the left-hand side. They reached 50 or 60,000 a day. They have fallen quite a way in the past few days, incidentally, but nevertheless, we look at hospitalizations, they've gone up a little bit. There's absolutely no pressure on the health service. Most people going into hospital are the unvaccinated. They're not getting terribly ill. The intensive care units are low capacity. And then that bottom line, the number of deaths, it's hardly measurable. Whereas in the second wave, it was 1,000 odd a day. Now it's running at a few tens a day. Not dismissing it, it's still an issue, but it's no more than we would lose with pneumonia or influenza. So this is becoming now a normal endemic. We're out of it. The UK has been lifted from its restrictions. This is the way the world's going to go. I'm wholly confident that as vaccines are rolled out across the world, this is going to work. Now, what I'm showing here is really very reliable leading indicators for where the global economy is going to be going. And you can see that we had this dramatic drop. Anything below 50 means the economies are going to be contracting. Well, guess what? There was a complete collapse. We'd never seen a collapse of this magnitude, the one we saw back in February, March, April, May of last year, completely off the page in terms of where we've seen these things before. And then we had a very sharp recovery. And now that brown line, which is developed markets, has soared ahead. A level of 60 is pretty much an all-time high, incidentally. So we've got this great spike in activity. It indicates very clearly that this recovery that we're seeing, this reopening reflation trade that we're seeing, is going to continue. It's coming off the top a little bit, I think, because of some concerns about the Delta variant, but it's still at very, very high levels. The blue line, emerging markets, perhaps not a surprise, they are not at the same level as the developed world, largely because of what you said, Magnus, which is that vaccines are still to roll out effectively across the emerging world. This has also been affected by China. China came out of the pandemic earlier than anywhere else. It went into it earlier. It's had very strong growth since then. It's now fading a bit. And there's a few other things going on in China which are causing some anxiety, not the least of which is President Xi's clampdown on big tech. But nevertheless, you can see the emerging world is still above 50, still growing. This points very clearly to continuing sustained growth. Now, the big thing that's been driving this growth as we come out of the lockdown is the release of pent-up demand. Now, this was a very, very different recession to anything we'd seen before. In normal recessions, you see a collapse in employment, people get out of work, house prices collapse, fall very sharply, people can't pay their mortgages, they end up with a whole lot of debt, it takes a long time to pay it off, they come out of it in a bit of a mess. This time around, it's been very different. Businesses and workers have been supported, but governments have either paid their salaries in large part, as in the UK, or they've given handouts to everybody, as in the case of the US. Businesses have been bailed out. And then really importantly, what this chart here shows is what has happened to household worth in the United States. The shaded bars there represent recessions. And guess what happens? Every single recession you see on that page, there's a collapse in household wealth because house prices have gone down, stock markets have gone down. Well, hey ho, this time round, house prices are up the best part of 20%. That's the biggest single asset of households. Stock markets is all-time high. We've had this great soaring in household net worth. So are people going to spend this excess savings that have been built up through the pandemic, which incidentally in the US represents about $2.5 trillion of excess savings they haven't been able to spend? It's about 12% of GDP. Are they going to go and spend that? Absolutely, because they're feeling rich. So this is going to carry on. We're very confident about that. It's going to be supported by these huge levels of monetary largesse, these quantitative easing programs that you talked about, Magnus. This chart shows here the asset purchases, the liquidity injections of the big four central banks around the world, the Fed, the most important, of course, the European Central Bank, the Bank of Japan, and the Bank of England. The numbers here are just staggering. $10 trillion they've pumped in terms of liquidity. You mentioned the South African stock market being capitalized at $1 trillion, so it would buy 10 South Africas in one go. And of course, if you look at the numbers compared to what happened in the financial crisis a decade or so ago, altogether different scale. Now, this is going to fade a little bit, these purchases, but they're going to fade very slowly. And I think the ECB and the Bank of Japan in particular are going to keep buying assets for a long time. So this liquidity is going to remain sloshing around the system for quite some time. Yes, the Fed will rein back a little bit, but cautiously. This has been driving asset purchases, and really importantly, unlike in the financial crisis, when the liquidity that central banks pumped in was used essentially to bail out banks which had gone bust. It was a systemic financial banking crisis then. This time around, banks are in very good health. They're able to lend, and that money is definitely finding its way into Main Street. And you've seen that money supply number up 25% or so, which Mike showed earlier. So this is all very positive for the growth to come. And then I show here the importance of what's happening in terms of fiscal spending. The bars there show fiscal spending in the US as a percentage of GDP. And you can see that the numbers there that we soared to 15, 16, 17% of GDP, sort of levels we've only ever seen before in wartime, incidentally, absolutely huge levels of support to the economy. Yes, that's going to fade as we come through the pandemic, but you can see there the numbers over the next decade remain very high. These are taken directly from President Biden's latest budget proposals. They're not yet set in stone with Congress approving it. There may be some shading back here, but there's a huge spending program coming on infrastructure, healthcare, climate change initiatives, the environment, redistribution of wealth, all sorts of things like that. And if this comes to fruition, there's going to be $1 trillion deficit every year for the next decade, on average, 5% of GDP, the most sustained, highest level of spending is since wartime. It's absolutely extraordinary. This is going to continue to underpin growth. So mark my word, this is going to be a long, long cycle. It does leave behind a little bit of a trail in terms of very high debt levels. You can see that line there shows the government debt as a percentage of GDP. That's going to get to about 100% of GDP. You wouldn't want interest rates going up hugely in that sort of environment. There's going to be a lot of debt around, not just in the US, but elsewhere, of course. And on the back of all of this, you've had growth expectations raised very significantly this year. So this is growth over the last 50, 60 years or so, World Bank figures. The red line, the dotted red line there shows the latest IMF figures. It's a reliable forecaster, not always right, of course. They've raised their forecast like everybody very significantly. They're now predicting 6% real GDP growth globally in 2021. That's the highest level since I started this business in the early 1970s, 1971 too. Incidentally, that's not going to, it will tail off a little bit once the release of pent-up demand sort of calms down a little bit, but they're still looking for almost 5% growth into next year. So there's going to be a great surge in growth, and it's coming right around the world, and it's going to continue not at 6% per annum levels, but because of those reasons I mentioned, it'll continue for over a long period of time. And if you look at this chart here, which I think is quite instructive, it shows the trajectory of cyclical upswings in the global economy. This represents the G7, so the big 7 economies around the world. It's indicative of the way the global economy goes. You can see that for the last 1, 2, 3, 4, 5 cyclical upswings, there have been very long periods of growth. This time round, the crash we saw in activity was on an altogether different scale, and we haven't even yet regained the pre-pandemic levels of GDP or capacity. The economies only really run out of steam when growth exceeds capacity. You get a surge in inflation, and central banks have to tighten policy. That's not on the horizon at the moment. There's 1 or 2 countries that may be getting up towards pre-pandemic levels. The US is one, but the vast majority are well below it. There's a huge amount of capacity around. This cycle is going to run for very many years. Yeah, not at 6 or 5% growth levels globally. It will settle down, but it'll still continue to provide reasonable growth, and that's a good environment, we think, for risk assets generally. So we're very constructive about the economy and for risk assets. As Mike mentioned, inflation is certainly the big issue of the day, apart from COVID. I'm showing here figures from the US, again, by far the most important. What we've got is well, the brown line there is US producer prices. The index there has moved to very, very high levels indeed. And one of the things that slightly concerns me about inflation is that you hardly need to pick up a company's profit statement or profit announcement in recent weeks, and they're nearly all referring to quite an increase in input prices, and that's bound to flow through to consumer prices in due course. What's happened is that pent-up demand has met with restricted supply constraints, primarily because of what happened in the COVID crisis. You know, supply chains were completely dislocated, and it's taken a long time to catch up. We all know there's a big shortage of semiconductors around the world, and of course you can't increase semiconductor capacity overnight. It takes a while to build that, but it is happening, and we're going to be watching very carefully to make sure that those supply chains do catch up with this strong level of demand. You can see that the headline inflation rate has moved to over 5%. The Fed believes this is transitory. Other central banks take that same view. And there's no doubt that the base effect of last year's negative inflation post-pandemic will fall away. And then I think what will happen, then we'll see inflation coming down. It may well be peaking at these sorts of levels, but we're going to be watching very carefully core levels of inflation. They have also increased to 30, 40-year highs. So we want to see those coming down. We want to see these supply chains getting back to normality. It's something definitely to watch for. And if it does become more persistent, that's one of the bigger risks. We still believe it is transitory, but the next few months are going to be important. I mentioned the fact that the Fed did tighten monetary policy, indicate a tightening of monetary policy back in its June meeting. It meets every few weeks or so. And it indicated that it will be reining in some of these asset purchases that it's still making. And it will be doing that, I think, before the year end. And it's brought forward slightly its expectation for when the first interest rate rise happens, but it's still not going to happen for at least for the next year or so. And we need to keep it in perspective. You can see that little blip up on the right-hand side. This is the yield on the 2-year US Treasury bond. And you can see it went from 3% in that 2008 period right down to effectively zero. It's blipped up a little bit, but it's going to go up very little from here on in until the Fed now makes a move on rates, and that's probably not for the next year or so. Nobody can tell me that this is anything but expansionary monetary policy. So this is still nearly free money. The only risk is if inflation picks up sharply, but this looks to us like a very, very long cycle of loose money for a long period of time. What we're showing here is I think, a sign that financial conditions remain really very easy indeed. The blue line is the yield on the 10-year US government bond, the nominal yield. It's arguably the world's benchmark in terms of pricing risk. And it's fallen from a level back in 2000 of 6-7% down to, well, it's actually about 1.2, 1.3% today, extremely low, almost still at historic lows. It's picked up from the immediate post-pandemic lows. The dark blue line there is the real yield. In other words, it's the nominal yield less the market's expectation of inflation. It's extraordinarily running at minus 1.1%. It's in negative territory. So in other words, if you buy this bond and inflation turns out to be what the market expects, which is that brown line, and that's still around about the 2.25% level, it's in the long-term averages of US inflation, you are guaranteed to get a negative real return. It does make, incidentally, the construction of the defensive part of portfolios rather more difficult, because this is the world's best defensive asset. There's still some room for it in portfolios, as I showed on that first slide in terms of returns, but you have to look for ways of diversifying beyond this thing. And importantly, that brown line, the expectation for inflation, yes, it's picked up since the pandemic lows, but it's still in that sort of longer term range through most of this century, still in that sort of 2.5% area. So at the moment, markets are not concerned about where inflation is going to be. They agree with the Fed, it's going to be transitory. Equity valuations. Now, equities have moved up a long way from the pandemic lows. Plenty of markets are up by 50% or more, some are up by 100%, and they've continued to move up this year. But the important thing is that this year, earnings are up by 40-50% in the US, a little bit less elsewhere, but rising very sharply. So although markets have gone up, valuations have actually improved. Valuations have gone down a little bit. And I think this chart is pretty interesting. First of all, it shows you on the right-hand side, expectations for the price-earnings ratio. A lot of these are still pretty low sorts of numbers, and particularly markets where there's quite a high component of companies that are going to be the biggest beneficiaries of the reopening of economies. UK, parts of Europe, Japan, I think will do well. The US is a bit more expensive. Arguably, the quality of earnings is higher, so it should be more expensive. But also, you've got a high component of these big growth stocks where I think they've brought forward some earnings and revenues from the next couple of years. So they are relatively expensive, could go through more of a sort of sideways movement here. But there's large parts of markets that still look very, very good value to us. And if you look at dividend yields relative to government bond yields, you're really being paid to wait. And incidentally, on the back of this big surge in earnings, you're going to get a decent uplift in dividend yields. So there's a very powerful case, we think, for keeping equities as the bulk of your risk assets, just as Mike was saying earlier. I can't leave this without talking about some of the risks. I'm conscious of the time, so I'll go through these fairly quickly. The top of the list, I put inflation. Is it going to be transitory, as the central banks think, as we currently think? But we're watching out for whether it becomes more persistent. You wouldn't want interest rates going up sharply. I don't think, incidentally, that central banks can allow interest rates to go up materially in real terms, because they're going to come up against this great barrier of huge levels of government debt. And paying off that debt is going to take a long time. You don't really want to be paying that off at high levels of interest. So I think we're in for a long period here of probably negative real rates. A policy error is quite possible. The Fed might get it wrong. COVID mutations, I mentioned that. Scientists are very confident, incidentally, that with some redesigning, vaccines are going to work very effectively with mutations, just as they have to date. with the UK variant, the South African one, the Indian one, as they're called. So I'm confident about that. Overhang of government debt will be an issue, and it's not. I don't think it's today's concern, but down the track we'll watch out for that. We want to see some reining in of debt. China's slowdown. Now, China, when I say slowdown, they're going to be slowing down to a rate of growth of over the next couple of years, 4 or 5% or so. I am concerned about the crackdown on its digital economy. I think that President Xi has gone back to the Mao's sort of autocratic approach. You see what's happened in Hong Kong. Hong Kong is a lost cause. The basic law that was agreed between China and the UK at the time of the handover in 1997, that's effectively been torn up. Free press is gone. And of course, there's nothing that anybody can do about it. The crackdown on the digital economy, I think, is serious. It's having a direct impact on the entrepreneurial culture in China. And I think it was certainly resulting in some reining in of growth expectations. I'm not suggesting that China's going to go into anything like a recession, but China under President Xi is a different beast to the preceding presidents when there was a much more open culture. US-China relations, well, they remain an issue. If anybody thought they were going to go away when Biden became president, well, forget about it. They've moved on from trade to cybersecurity, theft of intellectual property, you name it. And of course, this little issue of who controls the South China Sea. We won't talk about Taiwan. That's a very tricky one indeed. Regulation and tax of big tech is on its way. So I think some headwinds there. And importantly, these final 2 points, markets are discounting some recovery. So I think we need to be realistic about return expectations. I agree with Mike earlier, maybe single-digit return expectations from equities. The valuations are high in some asset classes, and I'm particularly thinking here in the fixed income asset classes, and there we diversify into specialist fixed income areas to get some higher yield, infrastructure loans, emerging market debt, high yield corporate bonds, that sort of thing. But we're mindful of the risk there, so you want to keep some defensive assets, accept the fact they are expensive. But the bottom line is this is going to be a long cycle ahead. We urge you to stay invested. We think there's plenty of opportunities, but do stay carefully diversified because there are going to be bumps on the way. Some of these risks are quite significant. Then just a couple of things on the funds that Magnus mentioned. We've been delighted and really honoured to be involved with Brenthurst for the past decade or more. It was a huge, with the benefit of hindsight, a hugely smart decision on the part of Magnus and the Brenthurst team, well ahead of its time to launch their own global balance fund 10 years or so ago now. The timing was brilliant, of course. That fund is broadly diversified. You can see there the strategic asset allocation, 60% equities, 40% fixed income. Within that, we diversify very widely across different markets, different regions, different styles of manager, different fixed income components. And it's broadly balanced to provide some growth, but with capital preservation. And then more recently, about 3 years or so ago, again, I think a really good initiative, Brenthurst launched a global equity fund with us, which is designed to produce returns broadly in line with the global equity market, but at low fees through largely passive instruments, blending different styles of manager together. And that's worked very well for us. You can see the returns here since the launch of that fund. Now, the blue line shows the returns of the global equity fund. It's returned about 35–40% over this period. When we get bumps in markets, as in 2018, and of course the very sharp bump in early part of 2020, the equity fund takes some strain, as you would expect. It's 100% invested, give or take, in equities. The balance fund, which is more diversified across different asset classes, more defensive asset classes, that's held up better, but it's still produced an aggregate return of 20-odd% over that period. So it's delivered some nice returns in US dollars there. And then finally, I'm happy incidentally to answer any questions on those funds, but very pleased to be involved with Magnus and the team on those. Finally, just to reiterate one point Magnus made. Magnus asked me the view from London on South Africa, and it's always a fair question. Unfortunately, social and political unrest is just what international investors don't want. So that's certainly a turn-off. I was sort of surprised when the riots were at their worst that the rand held up as well as it did, quite frankly. It's come off a bit, but not a great deal. And I'm a great believer in the resilience of the South African people and the country, and I'm sure it'll bounce back from that. But I don't think you have to sort of take a particularly negative view of South Africa itself to explain why you really should be invested outside South Africa with a significant part of your funds. And this slide here shows it quite nicely. And as Magnus mentioned it, South Africa represents less than 0.5% of the global economy. It represents less than 0.5% of global stock markets. So if you choose not to invest outside South Africa, you're leaving behind 99.5% of the global opportunity set. I don't think I need to say any more than that. And that opportunity set includes fabulous opportunities in the US, in Europe, the UK, and I think we're going to get some really good returns on equities over the next several years. I'm going to stop there in the interest of time.
Well, thank you very much, as usual. That was brilliant, and I think you've answered most of the questions. And I'd just like to wrap up by saying that the two Brenthurst funds are also now feeder funds in South Africa. You can invest rands into a dollar fund based in South Africa on local platforms for those people who need offshore diversification. I'd just like to thank the speakers, Magda Wierzycka, Mike Schüssler, Glyn Owen, and the ladies who put this all together. And to our participants who've been listening, they asked a lot of questions. I think they've answered most of them. This will be broadcast on our YouTube, and it will also be on our website within a couple of hours. And for those people asking questions like, how do I get more offshore into my portfolio? Remember, we have 9 offices countrywide plus Mauritius. You can go to our website, or you can simply email invest@Brenthurst Wealth, and one of our many planners will get hold of you. There are many ways to get offshore exposure. You can make changes in your portfolios. You can convert RAs to living annuities. You can take money outside with your single discretionary allowance, or you can take 10 million and more with your foreign investment allowance. There are many ways of doing it. Some are very cheap and simple, some more complicated. But talk to our advisors. They are independent. They act in the best interest of our clients. We don't work for any large company. And I'd just like to thank everybody for listening and staying tuned. We've got more than 500 people still attending the seminar. I'd like to thank you very, very much, and goodbye, and have a fantastic evening. Goodbye.